Oh my goodness. We are on the threshold of an explosion in innovation, and crypto is symptomatic of it. Uh, the seeds for what is about to happen were planted during the 20 years that ended with the tech and telecom bubble. Those seeds have been gestating for 20 to 25 years, sometimes 30 years, and are now beginning to blossom. And that's not even the right word. They are exploding into existence. So we think there are 5 major platforms, 14 different technologies that are all getting ready to move into the sweet spot of their S-curves. And there are going to be convergences between and among these technologies. So you're going to have one S-curve feeding another, and creating explosive energy and explosive growth. And I think in the crypto space, we're going to see blockchain technology and artificial intelligence converge and cause explosive reactions. So it's pretty exciting. Just to get back to investing in the future, when I was trying to explain to someone what I wanted to do before starting Ark, and who's not in our business, he said to me, "Oh, you mean that in the future of investing is investing in the future?" And I said, "You got it." Well, now, when I started in the business, that's the only way people thought about investing. And then we went through the tech and telecom bust, and then the 08-09 meltdown, and we ended up with huge risk aversion in the markets and a tendency to invest very much like the broad-based indices out there. In other words, not adding much more value than the indices themselves. And the indices are where they are because of what has happened historically. The largest companies, the most heavily weighted companies in these indices are there because of their past success. But if we're right, and all of this disruptive innovation is about to explode, well, they are in harm's way. Yes, well, this chart was drawn by Brett Winton, or developed by Brett Winton, who's our director of research. And he was working with academic literature to try and understand what would be the productivity or the impact on productivity of the combination of these platforms. And what he's depicting here is the productivity uplift is going to be unlike anything we've ever seen. We've had multiple platforms evolving at the same time only once before, and that was in the early 1900s: telephone, automobile, and electricity. And that world, that was the technologically enabled innovation of the time, and transformed our world completely. Let me put some numbers on where we are now. In 2019, when we did this chart, we evaluated the market cap around the world associated with truly transformative innovation. That year, it was $7 trillion. So it was less than 10% of the global equity market cap. That's public equity. The next year, last year, that doubled to 14 trillion. And we did have a very good year last year. We believe that in the next 5 to 10 years, that number is going to north of $100 trillion. But what we're not saying when so that's the upside. The downside will be in the broad-based benchmarks, which have been beneficiaries of the traditional world order and are now going to be disrupted and disintermediated.
So in order to summarize this section about like this explosive innovation, what is the current market holding true that you think the market is fundamentally wrong about?
I think the pace of innovation and the convergence between and among these platforms. Most investors have never seen exponential growth Well, they recall seeing it once. It was during the tech and telecom bubble, and that ended badly. And that's why there's been this allergic reaction to innovation and high valuations. Most investors have a 1-year time horizon, maybe 18 months. We have a 5-year investment time horizon. The early years of exponential growth, when we're at low numbers in terms of the base, the numbers don't look that much different from linear growth. But when you go out 5 years, the difference between exponential, so revenue growth rates in the 25 to 50% range per year, and let's say GDP growth, which might be 5% at best, night and day. And I think what gives us the differentiation is our starting point. We start from the top down, trying to size markets, and we center our research on something called Wright's Law. Wright's Law is a relative of Moore's Law. Moore's Law is a function of time. Wright's Law is a function of units. And actually, Wright's Law has worked better in the semiconductor industry than Moore's Law itself during the last few years. And so that's how we get to numbers like the electric vehicle space, 2.2 million last year, but the costs are dropping to such an extent now that we think that number is going to 40 million, almost half of the global cars sold in 5 years, actually more like 4 years now. No one has that kind of accelerated growth in their models. They've never seen it before, so they're not modeling it in the future. But Wright's Law is a very good guide.
Just to hop in and emphasize this point, because I'm sure Yassine and I both have built these Wright's Law models. Cathie's saying, like, as you increase the units of production, there's a certain cost decline curve to that technology. And so that's a lot of Ark's work of being able to predict out 5-10 years. What are the costs of these things going to be based on the units produced? There's this other thing that was coming to my mind as Cathie was talking. And Elon Musk has this line of fate loves irony, which always messes up my head. But when I think about how backward looking a lot of traditional finance has become, that comes at the same time, and the backwards looking is, as Cathie's saying, focusing on indices and investing based on the past. That's happening at the same time that the world is changing at an accelerating rate. And so there is this tragic irony that people are more and more backwards looking in their investing, at least institutions are, while the opportunity is getting larger and larger in the future. And I think that what's great about that actually is it opens up a space for retail. Ark is predominantly, I think, retail favored with growing institutional respect. And I think that will only grow over time. But the opportunity is really for retail to catch up to institutions. You guys say front run the opportunity, but it's just retail being future looking while the institutions are backwards looking.
There's lots of people who are willing to was just on recently. And he says part of this is because people are fundamentally afraid of change. Is there something to that? Why do you think there are like the haters of the world disparaging the work that you're doing and kind of your method?
Actually, I feel very comfortable when I'm in that kind of situation. If everybody loved what we were doing and they were chasing it, I'd feel much less comfortable. So I'm kind of used to it. I've faced it actually inside the traditional world as well, as I became an otter and otter duck, and my counterparts were becoming more benchmark sensitive. So, it was kind of, seemed like to them at least, rebellious. So are they afraid of change? I think there's muscle memory associated, certainly at the high level management, associated with the tech and telecom bubble. And many equity leaders went down and basically ceded power to the fixed income market. So many of the leaders of financial firms came out of the fixed income world because of the tech and telecom bust. Many equity leaders lost their jobs then, and then again, 08, 09. And so you have this very conservative group of people who really haven't managed equities ever, and actually understand more benchmark sensitivity, since that's how that world works. And I suppose this just seems like, again, an odd duck running around with her head cut off. They're not willing to look at the kind of research we're doing, which we provide freely out there. In fact, we provide our Tesla model, right? And to help to educate people, saying, look, we've done the research that supports these numbers. And I think the biggest surprise to me is that giving the research away, spoon feeding them with the models has not changed much. But I think it will change. We're just going to keep, if we are right, then those who are wedded to benchmarks are going to lose their jobs.